Hey Eddie, I just want to ask one question. What are the key components of the GST system and how does it works in a country like India?
The Goods and Services Tax (GST) system in India has several key components. 1. Single tax structure. GST replaces multiple indirect taxes like VAT, service tax, and excise duty with a single tax, simplifying the tax structure. 2. Dual GST model. India follows a dual GST model, which means that both the central and state governments levy GST. It includes central GST (CGST) and state GST (SGST) for intra-state sales, and integrated GST (IGST) for interstate sales. 3. Input tax credit (ITC). Businesses can claim credit for the tax paid on inputs used in the production of goods or services, reducing the overall tax liability. 4. GST registration. Businesses with a turnover above a certain threshold must register for GST and obtain a unique GSTIN goods and services tax identification number. 5. Filing returns. Registered businesses need to file periodic returns detailing their sales, purchases, and tax collected, ensuring transparency and compliance. 6. Rate structure. GST has multiple tax slabs: 0%, 5%, 12%, 18%, and 28% depending on the type of goods or services, ensuring that essential items remain affordable. 7. E-way bill. For the movement of goods worth more than a specified amount, an e-way bill is required, facilitating tracking and reducing tax evasion. In essence, GST aims to create a unified market, reduce tax cascading, and enhance compliance. If you have more questions or want to dive deeper into a specific aspect, feel free to ask.
Yeah, how do input tax credit work in GST and what are the conditions for claiming them?
Input tax credit (ITC) under GST allows businesses to claim credit for the tax paid on inputs, goods or services used in their business operations. Here's how it works and the conditions for claiming it. How ITC works. 1. Claiming credit. When a registered business purchases goods or services and pays GST on them, it can claim that GST amount as ITC when filing its GST returns. 2. Offsetting tax liability. The claimed ITC can be offset against the GST collected on sales, reducing the overall tax liability for the business. 3. Transferring credit. ITC can be transferred from one business to another in the supply chain, promoting seamless flow of credit. Conditions for claiming ITC. 1. Registered taxpayer. The claimant must be a registered taxpayer under GST. 2. Receipt of goods, services. The goods or services must be received by the taxpayer, and they must be used in the course of business. 3. Tax payment. The supplier must have paid the GST to the government. If the supplier fails to pay the tax, the ITC cannot be claimed. 4. Matching of invoices. The ITC claim should match the details filed by the supplier in their GST returns. If there are discrepancies, the credit may be denied. 5. Time limit. ITC must be claimed within a specified time frame, usually by the due date of filing the return for September of the following financial year. 6. Not for certain goods, services. ITC cannot be claimed on certain goods and services, such as personal expenses, motor vehicles with some exceptions, and specific exempt supplies. Understanding ITC can significantly impact a business's cash flow and tax liability. If you want to know more about a specific aspect or have other questions, just let me know.
No thanks, buddy. I got your point.